As you know, the UK left the EU political structures and the European Parliament on January 31st in 2020. That took Nigel Farage away from us, yeah. But the Brexiteers now blame the government for not implementing Brexit properly, and others want the UK to join the EU again. And I don't say rejoin on purpose. The EU, of course, moved forward after the UK left, and so in the next weeks I will make a test here on the channel by bringing news about the EU in my midday videos like this one. And that will keep people informed what the UK has left and what people want to return to, and that to make informed decisions and give it a more fact-based approach. And since my magazine channel is reserved for information on the development of the Russian war of aggression against Ukraine for the time being, that is another reason to do it on this channel here. But I anyway believe exactly my audience on this channel needs this kind of information. And of course, I set up a new playlist EU. But now let's talk about today's topic. It's a bit complicated, but bear with me. If micro, small and medium enterprises, the so-called SMEs, wish to operate cross-border, they become taxable in more than one member state as soon as their activity abroad creates a permanent establishment. The current systems of business taxation in the EU can be complex, which means that cross-border businesses can face high tax compliance costs, as well as risks of double or overtaxation and time-consuming legal disputes. And I mentioned in the beginning of the week that there can be changes. But this can prevent SMEs from developing their business in more than one member state, particularly for new enterprises. But how much are SMEs spending in compliance costs associated with corporate income tax? Well, corporate income tax related compliance costs in the European Union could amount to as much as 54 billion euros a year. Moreover, 90% of this amount is incurred by very small enterprises with fewer than 10 employees. SMEs spend approximately 2.5% of their turnover on compliance with their tax obligations, while large enterprises spend 0.7%. And this is because it is proportionally more difficult for SMEs to deal with a different set of tax rules of EU member states. The Commission's proposal I mentioned on Monday would give SMEs operating cross-border through permanent establishments the option to interact with only one tax administration, that of the head office, instead of having to comply with multiple tax systems. SMEs would therefore calculate their taxes based only on the tax rules of the member state of their head office. That's why it's called head office tax. SMEs would file one single tax return with the tax administration of the head office, which would then share this return with the other member states where the SME is operating. The member state of the head office would also subsequently transfer any resulting tax revenues to the countries where the permanent establishments are located. The scope of these rules would be limited to standalone SME entities with permanent establishments and would not be extended to SME groups with subsidiaries. Therefore, if an SME reaches a degree of expansion that allows it to grow into a group, it will no longer be entitled to the simplification framework. It would have the possibility to continue to apply the simplification rules, but only up to the end of the 5-year period of the option. The Commission's proposal will increase tax certainty and fairness, reduce compliance costs and distortions in the market that influence business decisions, while minimizing the risk of double and overtaxation and, of course, tax disputes. The expected decrease in compliance costs should in particular foster investment and cross-border expansion in the EU. SMEs operating in different member states will be able to fully maximize the freedom of establishment and the free movement of capital without being hindered by unnecessary tax-related obstacles. And once an SME chooses to apply the new rules, it will have to remain under the system for 5 fiscal years, unless the head office changes residence in the meantime or their foreign business activity grows exponentially in comparison to the business activity in the member state of origin. In that case, the rules cease to apply. SMEs will be able to renew their choice every 5 years without limit as long as they continue to meet the eligibility requirements. The eligibility and termination provisions are designed to discourage potential tax planning practices, notably the deliberate transfer of the head office to a low-tax country. But will this have to do something then also with this BeFit I talked about yesterday? The BeFit proposal is primarily aimed at large groups operating across the EU. The HOT proposal simplifies rules for SMEs during their early stages of the expansion. And if SMEs successfully expand and grow, they may outgrow the scope of the HOT rules, but then they will be able to opt into BeFit. In this way, the two proposals are complementary, and smaller businesses will be able to choose the best option for their own needs throughout their life cycle. And if you want to know more about the EU or British politics or Brexit, the next video is right in the end screen. I'll see you there. I'll be back.